Okay, welcome back. Today's topic will be discussing on RSI and how to use them like a pro. Before then, we are going to insert RSI. Under your menu, there are different menu here. You go to indicator list. This is indicator list. All of them have names. So indicator list are place where the program MetaTrader 5 or 4 indicator is being kept. So you go to indicator list. We have under indicator, we have different indicator. For the one that used to be on the chart, it is called, these are trend indicator. For the one that used to be down, is called oscillator, and RSI fall under oscillator. RSI means relative strength index. It helps in explaining the strength of the market. If the buyers are still strong, with the help of RSI, you'll be able to know. And if the buyers are weak, with the help of RSI, you are able to know. So before then, the parameter should be equal. You don't need any setting. Everything has already been set. So all you have to do, you set it in. Okay, this is RSI from here. Now on here we have 70, we have 30. This is the strength, the moving average. They call it relative strength moving average. This moving average is what determines whether the market is buying or selling. But before we continue, let us go to our slide to know what RSI is all about and how we can use it better. So we need to have a definition of what RSI is all about. So now, relative strength index, or RSI, is similar to the stochastic I know we have talked about stochastic in that it identify overbought and oversold condition in the market. It is also scaled from 0 to 100. Typically, reading below 30 indicate oversold, while reading above 70 indicate overbought. I remember at the initial early stage, I showed you when I inserted RSI that RSI have 70 and 100. So what that implies is that the 70 implies that if the market has been buying, let's say if the market has been buying all this while, going up, going up, going up, going up, going up, and we have RSI like this, like this, and like this, and like this. This is 70, and this is 30. Okay, now on this note and the moving average, there is a line that used to move indicating price action. I call it moving average. So when the moving average, as it's going, as far as it has not touched, it's still going. Why market is still going up? As far as it has not touched 70, market is still strong. Okay, it's still strong until when you just discover that this line has touched 70. Oh, market has got to the peak. Anything can happen within this level. So even if you have been buying oil from here to this place, you should know that once market have hit 70, what you should be expecting that the buyers are getting weaker, because everybody, when they say buyers are getting weaker, you know that they have taken their profit. They are satisfied with the level they have gotten. And because the 90, let's say the reason why this thing would touch 70 is because maybe we have 100 people that started buying from here. Now, once market get to here, already 80 persons have already taken profit, and they have gone out and started waiting for opportunity to sell. Okay. Now, this 80% is what the RSI is trying to tell you, that more people have left the buying position, and it's like more people are coming in for sell. So Because of that, they are telling you that you should leave the market now. The buyers are getting weaker, so that you will not lose or reduce your profit. So the oscillator RSI help us to navigate and see the clear view of the strength of the market, which is why they call it relative strength index. Okay, so on this note, let's continue. So now you can see vividly here that this is what I explained here. Price has been going up. If you notice between this level and this level, this is it. Okay. If you let me change it to black or to other color. Okay. Now, this, if you look at this, this is what I imply. As price got to 70, which is this, you can see clearly, price got to 70, it touches overbought level. Overbought level implies that the market has got to the peak where there will be a reversal or pullback or retracement. It all depends. So before a reversal, we turn to a retracement will become a reversal. It must have gotten to a certain strength. Maybe the retracement is going to be a reversal, but with the help of RSI, the difference between RSI and stochastic is that RSI helps you to see when the market has ended. Let's say with the help of RSI, if RSI touches overbought level, it means that there is going to be a total change of trend. But with stochastic only help you to indicate that market want to retrace. Market want to retrace. It's not a reverse. So RSI helps you to see when market trend has ended. Look at here. Let's give a scenario from here. Look at market has been going down from here. All this while it has been going down. But when market wanted to reverse finally, you can see clearly. Look at what happened. It touches RSI. All this while it has been going down. It did not touch RSI. You understand? It did not touch RSI because RSI can be used in different things. RSI can be used in different things apart from this thing. So like I was saying, RSI helps us to navigate and see when the market has ended, the market direction has ended. Let us go to a live chart so you can see what I am saying. This is a live chart of the live chart. I'm going to use a higher time frame so we can give you a clear view of what I meant. If you look at this direction, market has been rising all this way from this level. See, although this is just a retracement, it's another trend of its own. I want to start from where market's uptrend started. Yes, from here. Market has been going up from here. If you look clearly, you will see that this trend, remember what I said, for RSI to indicate a reversal or a retracement, it means that the market has gotten to a peak of reversing. But on that note, it can also be the big, like I said earlier, a retracement end up becoming a reversal. It's just like a caterpillar butterfly, metaphors to a butterfly. So before you will say that this market is going to be a retracement, a reversal, it has already to first of all be a retracement. So what RSI helps in indicating is that is to tell you that there will be a break, but they doesn't know whether that break will end up becoming a reversal but it doesn't tell you that these retracements have ended. It is only stochastic that will help you to know when a retracement have ended and when a retracement wants to start. But the work of RSI is to indicate when a trend wants to change direction. But it doesn't tell you whether that trend is going to be a retracement or a reversal. So most time, what RSI is mostly used is to measure the strength of the main direction. Let's say now, let me give a scenario. Market has been buying from here. Let's say market started to buy from here. You see, as market started to buy from here, you see it touches RSI. Okay, all this while it has been going down, going down, going. It fully touches over, which is 30. Remember, I say 30 is oversold. When you say oversold level, it means that the market has sold well. It has sold to the extent that it has touches the line of oversold. Sometimes it go below that, but as a wise trader, once you have been selling all from here, you have been selling all this while. Look at. You see why this market, this is where the market started to sell. Okay, this is the place where the market started to sell. Did you see that? It did not touch, but if you look at this market, if you look at this place, this is the place the market already touched. Look at the place the market touched. So with the help of, if you have been buying all this while from here to this place, and you now start noticing that market has touched, I've touched this level. I look at this one, it touches this level. The second one also touched this level. Even if you are seeing this market start going up, you should know that this is the final move. So RSI market might start going up, but once RSI have told you that this market has reached overbought level, get out. It might still pull back and make the last move and start going down. Okay, so RSI and stochastic and other oscillators that have this kind of look can be used to measure what we call hidden divergence and regular divergence. With the help of, you can use it to spot out regular divergence. Regular divergence is that if the RSI, like now, I measure from here, this is it. Now, as RSI have touched overbought and it will make the last move. With the help of this move, if this the main chart is saying here is buy, if the main chart is saying here is buy, and the RSI measure from this peak from here and measure from here again to the next peak, okay, and you now discover that the RSI is saying sell. So you can see with the help of, this is called regular divergence. Regular divergence is it with the help of RSI, you can actually dictate that the market has made his last move. So if you are not using this kind of strategy, which with time we will talk about regular divergence and hidden divergence, but I'm just telling you that apart from market touching overbought level and oversold level, you can also use RSI as an indicator that helps you to detect when the market wants to make a final reverse. Okay, with the help of this hidden divergence and regular divergence, you can be able to spot when the market wants to reverse. But mostly RSI is used for reversal, which is called regular divergence, while stochastic is used for hidden divergence. Hidden divergence is like trend continuation when we talk about that. But as for today, what you should know about RSI is that RSI is used to indicate when a trend wants to end. And how do you know that the trend wants to end? If the market is selling and the market touches oversold, which is 30. This is 30. If touches oversold, look at it, market start going up. If market touches overbought, which is 70, you see, it starts selling. So with the help of RSI, you can use it to indicate when the market wants to reverse and when they want to retrace, okay? But you should know that every indicator cannot give you 100% accurate information. That is why sometimes RSI might appear, like look at here, RSI showed here, but the reason why RSI first and touches this level and here it did not touch oversold is because he wants to form that divergence that I told you. Anytime you want to force that divergence, this place will first and touch overbought level or oversold level, but the next high will not touch. You know, there are strategies that if you don't understand, look at it here now. This one will only be the one to touch overbought level, but this particular one will not touch. So you want to form what we call divergence. It's telling you that this is the last move to buy. After this move, market will start going up, okay? So the same thing, but whenever market do not form that kind of move, it will only make the last peak to touch oversold level. You can see vividly, yeah, there was nothing like the regular divergence. They were all the same thing. Okay, regular divergence, look at it. Now, RSI is saying down. You only follow the instruction of RSI because RSI is telling you downtrend. You can see eventually market did what? Went down. But here, there was no divergence here. So what happened? The last peak become oversold level, and that was what triggered a buy. And this buy was not a long buy, but it's just a reversal, and it also fulfilled that agreement. Now, when you spot RSI, when you spot this RSI touching overbought level, like what I said here, when you spot RSI touches overbought level or oversold level, what will come into your mind is one thing. Okay, let's say now at this point now, yes, market has been going down. Okay, you now spot that there was a touch here at overbought level. Now, this touch triggers this reversal pattern, which is called what? Engulfing reversal pattern. After this engulfing must have touched, look at, you remember what I told you how to enter the trade with price action. As the RSI have touched overbought level, you are looking with, it's not when RSI touch over, you start buying or start selling. No, you watch out for a valid reversal pattern that will give you a good entry. A valid reversal pattern that will give you a good entry. You need a good reversal pattern that will give you a good entry. If you don't get that good reversal pattern, how will you be able? So as this thing has formed, look at it. So you spot out, what did you see? You saw RSI, you saw stochastic, you saw reversal pattern under the oversold level. This oversold level says that the sellers have exhausted their strength, therefore buyers will soon take over. But you must confirm it with this reversal pattern. As reversal pattern has formed, what do? You now look for a candle that is the most candle before this, before this one form, there is a candle that is higher than this. Which candle that is higher than this? You look at this candle and put your entry point here. Use the bottom here and set your stop loss and measure the distance between here and here. How many pips? If here is 20 pips, you measure 20 pips ahead. Or you target the next what? Resistant level, which is here. There will become your take profit level. The most recent, I talked to you about dynamic resistance and support level, and we talk about historical resistance. And dynamic are the most recent support level or resistance level. So if you are using that strategy of looking for the next resistance level, you should When you spot this reversal pattern, you look for a candle that is higher than this one. Before all this one form, there is a candle that is higher than this reversal pattern. This is this candle. Then you use here, this is the next take profit, because here is the most significant, most recent sub resistant level. Here become your take profit. You take your cross line and put here to give you the price. You use the bottom of that reversal pattern as your stop loss. You calculate your risk and you set your entry. The same thing in the other side. If you are to sell, if you are to also sell, let's give an example with sell. If you are up to also to sell, all you have to do is to look at where the market, okay, now this place market have touched overbought level, which is this place. Market touches overbought level at this point, okay. Here it has touched overbought level. Are you seeing that? Then the next thing is you are looking out for a reversal pattern. And what reversal pattern is this? This is a shooting star, okay? This is a shooting star, okay? As you saw a shooting star, what do? You look for a candle that is lower than this shooting star, which is here. Here becomes your entry point, and here become your stop loss, because this is the highest peak, okay? This is also doji. This is doji, gravestone doji. Then you can measure the distance between here, but if you know that you cannot get, where is your next support level, here become your next support level, okay? Here become your next support level, okay? This is the next support level. This is your next support level. But if you cannot, if your take profit is too small, you measure the distance between your entry point. If it is 20p, measure and get your 20 pips valid. That is it. That's how you use this indicator. But don't forget that with the help of all these indicators, you can make Forex trading easy for you. But that doesn't mean that anytime they appear, you see it will go smoothly. Okay, so that's why it's good for you to calculate your risk and your take profit before you enter the market. Let me pause so that you can ask your question.